Welcome to Yahoo Finance Live. I'm Julie Hyman along with Josh Lipton, and here's what you need to know as of 3 p.m. Eastern. Big tech fallout. Stocks trading lower today after Alphabet missed estimates in its cloud business for the third quarter. The tech giant shares are falling sharply today, down 9.5% and dragging the Nasdaq down with it. We've got more tech earnings after the bell today. We'll break numbers for Meta and IBM.
And we have a new Speaker of the House after weeks of chaos within the GOP. Louisiana Congressman Mike Johnson elected Speaker last hour. Johnson was the fourth candidate for the role after Kevin McCarthy was ousted. He is a vocal supporter of former President Donald Trump and has served in the House of Representatives since 2017.
Plus, housing hurdles, tight inventories of existing homes driving new home sales higher in September. 759,000 new homes purchased last month. That's up 12% from the month prior. And this coming despite soaring mortgage rates. And a slowdown may be ahead. Mortgage applications falling 1% last week from the prior week. Let's get you up to speed on the market action right now. As we mentioned, we are seeing a sell-off across the board here, but especially acute in the tech-heavy Nasdaq. That's because of those disappointing numbers from Alphabet and others. Right now, the Nasdaq off 2.4%, the S&P off about 1.5%. The Dow down a relatively mild 0.3% by comparison. That's about 113 points. Within the S&P 500, it's communication services, which, yes, you guessed it, Alphabet is a member, that is down the most. It's down almost 6% on the session.
So let's take a closer look here at these markets, and let's focus, Julie, for a second here on the NASDAQ, that tech-heavy gauge, because folks are pointing out it is now on track to enter a correction, so a drop of 10% from a recent high. We've talked a lot about how tech stocks can struggle as rates rise. That can be a tough environment for those to work in. We had some smart tech analysts come on our show and say, listen, they predicted it was going to be a real struggle, so they were looking to earnings, but now we have some big tech names reporting earnings, and as we know, those reports have been mixed.
Well, it's really fascinating, right? Because on the one hand, you did have Microsoft that was quite strong. On the other hand, you have Alphabet, which is being viewed negatively by the market. But it's really the loser that is winning out in terms of sentiment, in terms of tenor of the market today. And perhaps that is in part because of the rate environment. So I've been digging into the numbers here. As you pointed out, a correction is defined typically as the drop of at least 10% from a recent high to a recent low. The recent high for the Nasdaq Composite was July 19th. Since then, we have seen the 10-year yield go from 3.75% to nearly 5% here, 4.95% here today. So that's obvious that that's been one of the drags here. I've also been looking at the individual performers within the Nasdaq 100, because these are the larger stocks within the Nasdaq. Enphase Energy, the worst single performer, although it's relatively lightly weighted there, but that expresses the declines we've seen in anything renewable energy related within the group, right? Lucid has also fallen off. Illumina, which has had its own issues, as has Moderna. Dexcom also on that list. That is the device maker that got hit on concerns there's not going to be as much demand for certain types of medical devices because of the GLP-1 obesity and diabetes drugs. So some idiosyncratic stuff here, but overall, that risk-off environment that we have seen.
Yeah, and to your point, it's been a tale of two reactions, right? I mean, Microsoft, bottom line, those are strong results. Alphabet, as you noted, is getting absolutely walloped in today's trade. A lot of attention on the cloud business, which missed the street's expectations, and more importantly, showed that deceleration. The good news there was that advertising business, the core business, their bread and butter, search and YouTube revenue both came in better than expected, showed acceleration, and you wonder, does that bode well for Meta, which we're going to hear after the bell.
Exactly. So ad sales obviously going to be really important in Meta. And the other really important thing at Meta, if we draw the lessons from a Microsoft and an Alphabet, how exactly is Meta using AI in terms of tools? You know, it sort of played up the AI tools for advertisers that they were going to have access to. Are advertisers attracted by that? Have they been, drawn in by that? And is that going to be a source of revenue for Meta? It seems like, again, we've been talking about this sort of switch in the cycle here from everybody being very excited about generative AI to wanting more concrete evidence that it is flowing through to revenue and to the bottom line.
Yeah, no,
and that seems to be the
that's
big
exactly
divider.
right. It's one thing to say, listen, we're an AI-focused company. Back to your point, I think investors want to know, great, show me in the results where I can see that.
Yeah, exactly. Well, as we've been talking about, stocks are sinking with an hour to go in the trading day as Treasury yields surge once again. The 10-year hovering just under 5% here. Despite recent volatility in the bond market, the VIX shows that stocks have been fairly stable year to date. Our next guest says we should look out for hidden market risks that could be lurking. Let's bring in Melissa Brown, Contigo, Managing Director of Applied Research. Thank you so much for being here. So we've talked a lot about the risks that aren't so hidden, namely bond yields moving higher. What do you think investors should be paying attention to here?
Well, I think in general, investor sentiment is not good, and you see that in the performance of Alphabet today. They reported bad news and just got crushed for it. So I think the risk is in mildly bad news creating a big negative reaction, and if that starts to spread out across more stocks, I think overall that's not good for the stock market.
And Melissa, I know you're tracking sentiment. What about trading volume? Did that recover from the summer low here?
No, it's interesting that trading volume has remained quite low. It's well below where it was during the summer. And, we view that as being an indication that investors may not actually know what to do. Do I buy bonds? Do I not buy bonds? Do I buy certain kinds of stocks? Do I go into the Magnificent Seven, or retreat from them? And I think all of that has created kind of a paralysis. So investors don't know what to do, so they're not doing much of anything. And we see that in the volume numbers.
Speaking of paralysis, Washington, D.C. It has been an example of it as of late. But it looks like now that, as we talked about earlier, that there could be a Speaker of the House, and then it looks like it's Mike Johnson of Louisiana, who is towards the right of the GOP. Are there implications for investors here, namely when it comes to government shutdown, for example?
Well, I think on the one hand, there's good news in that there's been an uncertainty lifted. It was not clear how long we were going to go without a speaker, and at least we have that uncertainty lifted. On the other hand, it might be replaced by a different uncertainty about whether the government is going to shut down. And really what's going to happen with spending and so on. So, I think it's kind of a good news, bad news situation that we have at least found a speaker.
And Melissa, I'm interested, given all these different cross currents, so the drama in D.C. and earnings, geopolitical risk, still seeing a relatively low level of volatility. What explains that, do you think?
Well, I'm not sure I know exactly what explains it. Until recently, we had many stocks that were kind of, moving. You had the Magnificent Seven, then you had, other stocks. They were not necessarily moving in the same direction. So low correlation between stocks tends to drive volatility down. But it's not clear to me. Correlations have gone up and volatility has still stayed relatively muted. We think that, there might be a false flag there that, investors are perhaps getting a false sense of security by this low volatility. But then we see some, bad news comes out, the already negative sentiment starts to kick in. And then, you have everybody heading for the doors because it doesn't look like they've been expecting this bad news that that may be coming out, and so that's a big concern. In general, low volatility can be considered to be good, but it's not always good. And in fact, before other market peaks, it has been relatively low.
So, Melissa, does that imply here that investors need to get more defensive, or they need to hedge their more bullish positions in case of more negative surprises?
I think that certainly caution is in order. We want to continue to watch as earnings are coming out and see what the reactions are. But in general, and I tend to be relatively cautious anyway, but I think that taking a more cautious stance perhaps by hedging, perhaps by just, kind of moving from riskier stocks to less risky stocks, or moving from stocks to bonds. It doesn't seem like that is going to be a terrible call given this kind of environment.
And given this kind of environment, we just talked about the Nasdaq now entering correction. It looks like it's going to close there down 10% from its recent high. Do you see more downside from here?
Well, I mean, we are looking at pretty high valuations, which is another potential issue. If stocks are cheap and their earnings are a little bit disappointing, that's generally not a big problem. But if PE ratios are high, there's, first of all, it's more likely that bad news is going to trigger that decline. And the higher the PE, the higher the decline potentially could be. And so I wouldn't say that every time we, cross that 10% threshold, we always get another 10% or say. But I think, certainly all the building blocks are in place that it could continue to go down.
All right, we shall see. Melissa Brown, Contigo Managing Director of Applied Research. Thanks for your time. I appreciate it.
My pleasure.
We're just getting started here on Yahoo Finance Live. Coming up, testimony time. Sam Bankman-Fried is set to testify in his own defense. We were wondering if it was going to happen. His lawyer says, yes, it is. We'll get you all the latest details on that. Also, the return of spooky stocks. We're breaking down the 5 stocks. I just do that to make Josh laugh. The 5 stocks that have spooked investors lately. Today, we're going to break down JD.com. And after the bell, of course, we will bring you the latest earnings reports from Meta and IBM, plus instant analysis, all that and more when Yahoo Finance returns.
$2023 rocked the markets.
NVIDIA, the stock has been on a tear this
Silicon Valley
week.
Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Alphabet and Microsoft are headed in opposite directions. It's after reporting quarterly earnings. Microsoft's cloud business surpassing the street's expectations, while Alphabet's cloud unit disappointing. But for investors, it seems AI is the main focus. Josh Schaefer has been looking into all of this. Josh.
Yeah, hey Josh, that's something we've been following for a few quarters now, is sort of how stocks react in the day after these earnings calls, and specifically what those executives said about their AI strategy and what investors are sort of looking for when it comes to that. And an interesting thing we found in the difference between Microsoft's earnings and Alphabet's earnings was Microsoft was able to provide investors a number to attribute to that cloud growth. So Microsoft Azure growing 29% last quarter, that they charged 3% of that. They said 3% of that attributed it to AI. When Alphabet had their earnings call, they weren't really able to attribute specific numbers to AI. We saw this last quarter with Meta as well. Meta was able to say, well, people are spending more time on Instagram, on Facebook because of AI that is leading to X ad sales and Y revenue. And investors responded positively to that on the day after. So it's an interesting trend we're seeing in these calls. Basically, yes, we know you're all spending on AI. Everyone has big plans for AI. But what does it actually mean for the company, and is it bringing in sales now, is something investors are watching. I should mention, though, as we see Google shares down about 9%, a lot of the street's still coming out with positive commentary on Alphabet today, saying that, yes, we did not necessarily see AI revenues come to fruition last night, but it is something we're still expecting. I think Brent Thill at Jefferies put it well. Maybe we just expected a little bit too much this quarter, but management wouldn't be putting that much into AI via capital expenditures if they weren't expecting revenue to come at some point. So Jefferies still has a buy. Plenty of firms out there still have a buy on Alphabet and just believe that AI strategy might be coming a little bit further out in the future than it is for Microsoft.
But for today, those stocks really going in very divergent directions. So zooming out a little bit, Josh, if you look at these two companies, what are the lessons, right? Are people going to be asking the same questions pretty much of every tech company now?
Yeah, Julie, I definitely think so. And I think what we're seeing is just the divergence, right? It's something we're seeing across the stock market right now and across sectors. Really, we're just talking about a lot of uncertainty and a lot of, well, what's the actual read here? When we think about what we normally learn from cloud spending, we're thinking about business to business spending, right? And are businesses still growing and spending more, or are businesses not growing and maybe cutting back on spending? If you look at Alphabet's report, you'd say businesses are probably cutting back on spending. They're not giving Google as much money for Google Cloud. You know, maybe they're sort of being more conservative. But then you look at Microsoft and you say, oh, companies are actually spending on cloud. They're spending more business to business. So you can't get a clear read here. And I thought BlackRock's Rick Rieder really put this well in terms of what it means for the overall market. I want to take a listen to what he told Yahoo Finance this morning.
There's dispersion. I mean, you look across, you know, even last night, like you saw, I mean, the numbers that came across in terms of cloud performance, in terms of broader technology performance, I know there's real dispersion. I mean, you know, we're getting a series of conflicting signs around market studies. It's why markets are so jumpy, so uncertain.
And so, Julie, that's really the story right now. You think about the economic story that we've been following. You could look at one side of economic data and say things are coming in well, manufacturing's doing well, inflation is generally coming down. But then you could think about what that means for the Fed overall, and maybe inflation isn't coming down quick enough, and maybe the economy's too hot. Maybe things are still uncertain. And I think that uncertainty is, of course, what has brought us to a market that doesn't really know what to do right now. We see stocks down today as yields rise. Yields have been driven by uncertainty, and that's brought us to this moment where we're sort of looking for the next catalyst for the stock market, because right now it's really just been a story about yields for, it feels like, a long time now.
Yeah, indeed. And Melissa Brown of Contigo just a few moments ago echoing those comments. And guess what? There's another thing of uncertainty coming, possible government shutdown. Fun. Josh, thanks so much. Appreciate it. Well, Qualcomm is looking to ramp up competition in the PC space, unveiling a new chip, the Snapdragon Elite X for Windows-based laptops. It claims, Qualcomm that is, that it's going to be faster at some operations than Apple's chips for its Mac computers. This chip is set to debut next year, and it's been redesigned to take on artificial intelligence tasks as well, as have some other new chips coming out from Qualcomm. Joining us now, Cristiano Amon, Qualcomm CEO and President, joining us from their Snapdragon conference out in Hawaii. Thank you so much for being here, first of all, Cristiano, and taking the time to talk to us. As always, it's good to catch up with you. Talk to us about this new PC chip in particular. Why is it such a big step for you guys? And what do you think it says about where the industry is pushing right now?
Absolutely. Look, good to talk to both of you. Wish you both were here with us in Hawaii when we're making some very exciting announcements for Qualcomm, probably one of the best summits we had to date. But to answer your question, we've been working very hard for many years waiting for this moment. We have been partnering with Microsoft to build the next generation PCs. And we just announced the Elite X has the fastest CPU or any battery power mobile computing device. It's the fastest CPU or any laptop. It outperformed the competition, both on what you have seen with the M series from Apple, but also even the Intel i9 for a gaming laptop. And that's not only about the CPU. I think what is interesting is about this whole show, it's what's happening with Gen AI on device. It's evolving a little different than the cloud, and we see incredible opportunities for the Microsoft Copilot with one of the fastest NPU, neural processing unit, highly differentiated from Qualcomm, to process a lot of those Gen AI models pervasively, always running natively on this chip.
And Cristiano, more broadly, with this news, you all are obviously making a bet on the future of the PC market, that in the quarters, the years ahead, Cristiano, you believe that PC market obviously is going to be healthy and strong and vibrant. Why do you believe that, Cristiano? What are the tailwinds you see in the PC market?
So, Josh, I need to step back and talk about what exactly happened with our company. Our company has been very focused in diversifying and generate growth to other end markets for Qualcomm beyond mobile. If we look at what's happening with the PC right now, we see too many drivers of innovation and change. The PC is becoming a communication device. The PC is becoming more mobile, more portable, and you have Gen AI, which is changing a lot of the use cases and the experience. So for us, it's an incredible growth opportunity since we're not a relevant player in the PC today. And now, all of a sudden, having the chip that has the leadership capabilities and is better suited for those new Gen AI experience, that's a great opportunity for Qualcomm to grow in the market starting in the second half of 2024.
What are you hearing from customers thus far? And I ask this not just from the customer who's making the PC, but also the end user of the PC, because I've read some older reviews of ARM architecture chips in PCs, the Surface, for example, and they haven't been great, right? So what are the differences that the end user is going to see, and then what kind of demand are you hearing about from folks who make these devices?
So, it's important to understand that we have been building up to this moment. So we knew, and we've been very clear about that we have been working with Microsoft to a number of generations to get the ARM instruction set into the Windows ecosystem. But it's I think we're getting to the place now that we can clearly see that is the new TAM for Qualcomm. Just pointing out some NVIDIA talk about, or we saw some news about an ARM CPU development. The PC is changing from x86 to ARM. And I think what is different now is we have done all of the work with Microsoft to create that ecosystem. Now you can run with Windows 11, you can run all 64-bit apps, 32-bit apps, and then next year with Windows AI, you have the Gen AI use cases. That's what's different. We've been working to get to this moment. Now we have the silicon, we have the AI experience, and we have a mature ARM ecosystem now in the PC space.
And Cristiano, the new product you announced, you argue it beats Apple, it beats Intel. But when you think about these two companies, Cristiano, I mean, these are two big companies with very deep pockets. I think of Intel in particular. I mean, they've got salespeople, Cristiano, who've been selling into the enterprise for 20, 25 years. I mean, these are long-standing relationships. How do you disrupt that?
Look, as I just said, it's inevitable. The PC market is transitioning to a different instruction set, and the PC and mobile convergence is happening. Look, Apple did the fantastic job with the M series, and you saw kind of the devices they built. Our job is to build the same for Microsoft and the Windows ecosystem. That's the mission that we've been assigned. We are very happy with the Microsoft support. And at the end of the day, our job is to build the best possible technology. Microsoft will build the best possible experience. And if that makes a difference for our consumers, they're going to buy this device. It's not because of channel.
I guess I'm trying to understand, Cristiano. You're obviously working closely with Microsoft on this, but Microsoft is also working closely with your competitors on this. So what is it that is going to put Qualcomm over the edge in an area that it has not traditionally been? Is it going to be the speed? Is it going to be the power? How are you going to outperform and outcompete, kind of to Josh's point here, some of the long-standing participants in the space?
Look, I'll look at this question a little bit different, frankly. So you should look at this. We have been working on this for a number of years now. All of a sudden, when Microsoft is getting ready for the next Windows AI, we come up with the fastest mobile processor in the industry, period. And we haven't even started. And I think everybody's worried about all this competition. There is change happening. I think we have been reimagining the PC. And at the end of the day, I think, leading technology products will drive consumers. That's what happened with the Apple M series. And I think Windows is doing exactly the same thing. But I will not discount something very important. You just saw Microsoft had incredible earnings results. I think you guys have been talking about that. You see the value of the Copilot for a lot of the enterprises and how they're thinking about that's a growth expansion. We have Microsoft responsible for Windows driving those new experiences. And I think that's a very powerful force to create an upgrade cycle. And we're excited about that opportunity for Qualcomm in 24.
And Cristiano, I want to get you out on this. The stock this year, Cristiano, I'm looking here, you're down about 5% year to date. And a big reason there, as you well know, investors are concerned about the trends they see in the smartphone market. What are you seeing, Cristiano? 6, 12 months from now, what does that smartphone market look like?
Look, I think first comment is we have been clear that we have seen that the market has been shrinking as when we look at 2023. It's a smaller market than we have back in 2019. And phone has always been one good proxy of economic and consumer confidence. If you look at the macroeconomics, interest rates, we have seen that consumers had postponed buying a new device. As a result, the market became a little smaller. However, One exciting thing we're seeing at the show at Maui, which is a lot of our customers are basically building the next type phone with a big change in the user experience with Gen AI. And that's very different than how the Gen AI is developing on the cloud. That could create a new cycle. It's very hard to predict the phone market. Maybe the worst is behind us, and the new Gen AI technologies could create a new cycle. We can't really predict that, but that underscored the reason we're so excited about continuing to differentiate and diversify Qualcomm, finding new end markets for our technology.
Yeah, and I think people are definitely excited about potential new Gen AI capabilities in their phones when we start to see more and more of that. Cristiano, obrigado. I'm practicing my Portuguese ahead of a trip to Brazil, so I can thank you in your native language. Cristiano Amon, thank you so much. Really appreciate you taking the time.
Thank you. Pleasure talking to you, and safe travels.
Thank you. Well, let's get to some movers that we are watching today now, some trending tickers. We've got the fintech stocks that are trading lower today. PayPal and Block both under pressure. Affirm also selling off today. And this has to do with a French company called Worldline that is in the same space. Now, some of Worldline's issues are specific to itself, but Worldline shares were down 59%. That is a record single-day drop after the company lowered its outlook for the year. It scrapped growth targets, and it cited Europe's economic slowdown and the risks of cybercrime. Now, basically what this did was sort of highlight concerns that are out there in the market about spending patterns on the part of consumers. Even though you had the likes of something like Visa's numbers looking relatively strong, there are still these concerns lingering for fintech in particular.
Yeah, and you point out Worldline does face, we should note, some unique challenges, right? I mean, Bloomberg pointing out, you know, their largest market is Germany, which is facing a possible recession. So there are some unique things here, but broadly the sector is facing some challenges. You know, the e-commerce boom we saw during COVID, that has faded. Rising rates is another challenge, and the damage is intense. I mean, PayPal down 30% this year. Block is down about the same. Affirm, though, bucking the trend. Max Levchin's company is up about 70%. But overall, for the sector, there are these headwinds they're trying to navigate.
Right, and over the past week or so, we've definitely seen these stocks continue to sell off because higher rates are, you know, just like a headwind for most of what we're talking about.
Exactly right.
Particularly for this sector.
All right, moving on. Also going to check out shares of automatic data processing down today after the company reported a mixed earnings report. You can see it's down hard, actually, about 9%. So on this one, Julie, revenue grew 7%, but that did miss estimates. Total expenses were also up about 7% to $4.51 billion. That and for fiscal 24, they do see adjusted EPS between 10 to 12%. Revenue growth, they're looking for between 6 and 7%. Bears don't think much of what they see here. No surprise, right? They have sells on it. But Evercore is one example. They got an underperform on the name. They say continued deterioration will likely be driven by a worsening macroeconomic backdrop. Most on the street, we should note, though, are at a hold, more than 60%. The stock now firmly in the red here today.
Yeah, and, you know, basically this seems to be a reflection of the slowing job market, right? But given that we continue to see a lot of job numbers beat estimates, it's kind of interesting here that ADP is reporting this, and you have to ask the question, are there sort of forward-looking indications about what's going to be happening with the job market? I mean, I think economists broadly are predicting an uptick in unemployment as the Federal Reserve's rate increases continue to bite. So maybe this is sort of the tip of the spear, as it were, letting us know, or the canary in the coal mine. I don't know, mixed metaphors.
No, I get where you're going
idea. You know, is this telling us that there is definitely more trouble to come?
Yeah.
I think
all right. Well, we'll keep our eye on.
Yeah. Let's also keep our eye on Waste Management. It's one of the best performers in the S&P 500 right now, up 6% following its earnings. The company reported third quarter results that did feature weaker than expected revenue, but it did raise its full year forecast for free cash flow. So hence we see the stock moving higher here. Waste Management, one of the biggest waste management companies in the country here. And the analysts here are looking at better margin performance, according to the likes of Oppenheimer, and that more than offset lower revenue. So basically managing expenses better, and also, though, seeing some commodity impacts that did not help the company. So interesting here. Again, waste management, stable, but also maybe a bit of a bellwether, right? When you look at trash as a proxy for economic
Maybe
growth.
you want to get defensive, you move to waste stocks. That could be it.
Yeah,
perhaps, right?
You see some of that traditionally.
I mean, I think to your point, so Q3 profit beat, revenue rose about 2%. That apparently was kind of short versus what the street was looking for. But as you noted, Julie, I think one of the things the investors are really concentrating on here, the company now expects free cash flow for 2023 between 1.83 and 1.93 billion, and that was raised.
Yeah, exactly. Now, the waste management companies tend to have a decent dividend yield. Theirs, though, is 1.7%, so not huge here, drawing investors in terms of that. So we'll keep on watching that one. Well, coming up, Sam Bankman-Fried, he's now going to take the stand. We were wondering if he was. Sounds like he is. The indicted founder of FTX faces 7 counts of fraud and money laundering. We've got all the details on what to look for from his testimony next. Sam Bankman-Fried plans to take the stand at his criminal trial. The FTX founder is set to testify in his own defense as he faces 7 counts of fraud and money laundering. Here with the latest, Yahoo Finance's Alexis Keenan. Alexis, we've been talking to a lot of folks who are trying to say, will he or won't he? And most of the attorneys we've talked to have said he shouldn't, but it sounds like he's going to.
Yeah, this is a high-risk gamble here. And we learned this information just hours ago in a hearing where Bankman-Fried's lawyers appeared. And his attorney said, our client is going to be testifying. And that should mean possibly even tomorrow, because that's when the prosecution is expected to rest its case. Of course, at the heart of the Justice Department's charges against Bankman-Fried are claims that he let his crypto trading firm Alameda Research spend FTX customer funds and lose them, as we now know. Now, this huge gamble is one that most defendants don't take, and that is because of the essentially high risk of cross-examination. And that's where prosecutors can ask Bankman-Fried a wide range of questions. And so far, we know little about what Bankman-Fried will say. This is a criminal case, and so we don't get to see his case in advance. His attorneys say, though, in this new letter that was filed with the court, some information that gives us a bit of a hint about what he might testify to. His attorneys say that Bankman-Fried intended to repay customers and that he believed that the use of FTX customer funds would not cause customers harm. It also says that he thought the use of those funds was permitted in the relationship between FTX and its customers. Now, what Bankman-Fried did intend, that will be critical since all of these charges, all 7 of them, hinge on intent. It's an essential element of the prosecution's case. They must prove intent on each and every charge beyond a reasonable doubt in order to convict him on any of those charges. The defense also said that they expect, though, to call 3 additional witnesses. They should testify before Bankman-Fried. But we will be at the courthouse, and we will bring you the latest as soon as we hear what Bankman-Fried has to say and what prosecutors challenge him on. Guys?
All right, we'll be waiting. Alexis Keenan, thank you so much. And it's earnings season, and Otis, the elevator and escalator manufacturer, reporting better than expected results on the top and bottom lines. The company has literally and financially seen some ups and downs year to date, but after a strong third quarter, it has now raised guidance for the rest of the year. Judy Marks, the company's CEO, sat down with Yahoo Finance executive editor Brian Sozzi, and he first asked about the performance.
Top line, we were up organically 5.2%, but really strong margin enhancement that we drove through 60 basis points. We finished this quarter our highest ROS, highest margin since we spun. And it's really driven on the strength of our service business. New equipment did well, but our service business, it just again showed its resiliency across the globe. All 4 regions growing. Our portfolio now is over 4% growth every quarter for the last 4 quarters. And we're going to approach 2.3 million units by the end of the year on our service portfolio.
Help us understand that resiliency, Judy. What are you hearing from customers in this environment?
Well, we're hearing a few things. We're hearing on the service side, we're hearing the need for sustained maintenance, repair, which is kind of the break fix business we thought would go down a few years after the kind of the post-COVID surge. It's still remaining strong. And we're hearing modernization and refurbishment because construction boom happened significant decades ago, and it's time for modernization. On the new equipment side, little different story for everyone to know. China is still really seeing some headwinds in new equipment. We're now saying the market's going to be down north of 10%. And especially North America, US, is going to be down mid-teens. We've seen really a lot of jobs before they even get awarded being held now because of interest rates, primarily multifamily, followed by commercial. Infrastructure still looks good. But we're seeing a little tap on the brakes, certainly in the U.S. and the indicators, whether they be the Architects Billing Index, Dodge Momentum Construction, they're both down this month, and that's what we're seeing in the market.
You just brought a lot of economic reports to life, Judy. That is just fascinating stuff. Do you think from your perch, this was the first quarter where your business saw the impact of higher interest rates?
I think we're seeing developers be cautious. So whether that's in China because of liquidity or here in the US because of interest rates specifically, I think we're seeing some caution. The strength of our new equipment business, though, Brian, is we've got a great backlog. Our new equipment backlog, even with these challenges, is up globally 2% in constant currency. Our modernization backlog's up 15%. We're a long cycle business, so this gives us really good line of sight in new equipment in North America, probably for the next 12 to 18 months. We've got work we need to convert. And in the rest of the world, we still have multiple quarters left of work to convert.
Do you think, look, I'm not going to ask you to play macroeconomist here, Judy, but do you think we need some form of rate cut next year to ease that concern amongst developers?
You know, I'm not an economist, and but what I will tell you is I think we've hit a level where people are questioning investment. Not in infrastructure, not in public-private partnerships, but where people have the opportunity to delay, especially private developers. I think they're working on the math because of the interest rates. So anything that can either stabilize or reduce would certainly be beneficial in North America. In Europe, we're not seeing the impact of rates as much. We're seeing part of it in Germany and Northern Europe. Southern Europe's still really strong. Spain, Italy, Middle East is still strong. And then Asia Pacific is still growing. India is growing significantly, as is Southeast Asia. So, you know, all in all, you know, it's this geographic diversification we have which is our strength in new equipment, but it's our service business that just is the foundation and about 80% of our profits.
And thanks to Brian and to Judy Marks, the CEO of Otis. Coming up, spooky stocks. Chinese e-commerce giant JD.com down more than 50% this year. That's pretty spooky. What's behind the decline? We'll tell you and give you some advice on what to do with the stock next. A week ahead of Halloween, we're looking at stocks that have spooked investors as of late. And today, we're looking at Chinese e-commerce giant JD.com. The U.S. listed shares are under pressure. They're down around 55% since the start of the year. The Hong Kong shares down a similar percentage. And in fact, JD is the worst performer in the Hang Seng Tech Index so far this year. And in the Hang Seng more broadly, is second only to troubled real estate developer Country Garden. The retailer's been hit by broader concerns over China's slow economic recovery post-pandemic. China's seeing slow growth, high youth unemployment, and a debt crisis in its property sector. Specific challenges for JD.com include competition, weak consumer spending, and implementation of a low-price strategy to try to attract customers away from rivals. JD.com is lagging behind its rivals, Alibaba and PDD Holdings, when it comes to attracting merchants and distributors and implementing that low-cost strategy. That's according to Morningstar. In March, the company warned it would take time to rebuild consumer confidence post-pandemic. And last week, the stock hit an almost four-year low after a number of analysts lowered their price targets and third-quarter revenue growth forecasts. Now, despite the challenges, there is some optimism on the street. In fact, the stock has 40 buy ratings, 10 holds, and only one sell. For more on JD and the state of China's economy more broadly, where to invest as well, we bring in Anthony Sassine, Crane Shares Senior Investment Strategist. Also with us, Jim Warden, Chief Investment Officer at the Wealth Consulting Group. Guys, thank you so much for being here. Really appreciate it as we try to figure out what is going on here with JD. Anthony, I want to start with you because we've seen, obviously, a lot of these concerns affect the Chinese market more broadly, but JD has really taken it worse than its competitors. What's going on here, and is it near any kind of turning point?
Absolutely. Thank you for having me. Yeah, I mean, JD was harder hit this year because of the recovery, and we've seen despite seeing retail growth growing 3.1% and online retail growing double digits, 11 to 13%. the actual furniture and appliances, electronics and appliances, which is the main bread and butter for JD, has actually been flattish to a little bit declining this year. So that's basically hitting JD's bottom line. But also it's good to remember that JD had a really good 2020 and 2021 post pandemic when people were locked in. They were buying electronics and other things that JD was selling. So now we're seeing that stock kind of recede a little bit this year.
And Jim, I know you don't own JD, but you do own Alibaba, so you understand the space in the market. When you think about JD's competition with Alibaba or Pinduoduo, how does JD just fit into that market? Does it have certain competitive advantages, Jim, that the others two don't?
Yeah, thanks for having me. It's a really, really tough space to be. From a macro standpoint, we're seeing slower growth globally. We're seeing slower growth in China. When I look at our holdings that are kind of in this space, not all of them are in China, but it's been tough. It's been a very, very difficult ride. Only Amazon and Mercado Libre are doing well. It feels like a value trap. The fundamentals are not that great, and in some cases, even though we see that the analysts, most of them still have a buy rating, the price targets have gotten lower and lower, and I feel that and we might actually have $20 support level, which we saw in 2016 for JD.
Anthony, so as you look at that characterization of a value trap, I'm curious what you think of when you look at JD, if you would characterize it that way, or if you think there's some real potential opportunity here.
I don't think it's a value trap. Look, the e-commerce opportunity in China is a major opportunity for long term. We're still only at 27% penetration of total retail, and JD is one of the highest quality e-commerce players out there with very superior logistic capabilities. But JD, it happened that this year they focus usually on brands and electronic and appliances, and that's not growing because China's recovery is not coming back. But if you look at it for the future, I think JD is best positioned to kind of capture the recovery, right? Because you have very low valuations today, and despite high savings, people are not buying big ticket items. They're actually, if you look at low ticket items like clothing, apparels, footwear, these are growing double digits, 15, 17% year to date. That's why you're seeing Pinduoduo and VIPS doing well. So if you want to capture that recovery, I think JD is better positioned. But we always recommend with investors, these companies are going to go through cycles, ups and downs. We're very optimistic on the long term. We think everything is going to move online, despite the short-term noise and the short-term bumps. That's why we recommend people to access these companies through ETFs like KWEB, where you get the whole basket. And then as these companies go through cycles, you continue to earn, the return or grow with that pie, the e-commerce pie, over a long term.
And Jim, back to you. I have sort of a broader question for you, Jim. I'm just wondering, if you're an investor and you're listening to this right now, before you put money to work in a Chinese name, a Chinese stock, I would think you have to understand what the regulatory environment is now and what it's going to be. And do you think, Jim, we really have any real insight and clarity there?
Question, I don't think it's super clear right now. I think whenever we're investing outside the United States, there is a certain degree, a certain level of risk that we're taking. We know we need to be diversified. We know we need to have some exposure outside, but then it comes down to country-specific issues and, what regulations can happen over in China, what our regulations can do to those investment theses. So we're constantly looking at the thesis. How does that change? And trying to stay on top of it.
And Anthony, obviously the situation in China is variable, as Josh and Jim just alluded to. So when you talk about buying a basket like KWEB, I mean, that basket has been very reactive to sort of rhetoric from the U.S. government, for example, or back and forth between the U.S. and China. So how should investors sort of frame that and think about that?
Yeah, I just want to say that's why we are here for, right? To help you walk through, the complexities of investing in China or anywhere in the world. We happen to be focused on China. So, to invest in China, you need to understand the cultural aspect of China and the ideology behind what's happening, right? So basically, over the last 2-3 years, it's been tough, especially for e-commerce, because the Chinese government decided to move things a little bit towards socialism in a way, but still capitalist, but also kind of regulate this major industry that is, it has become too big to fail. So the right idea, but I think the execution wasn't as great as we expected. Now that's done, right? So we can tell you now that's done. Now the government is actually looking to help these companies, right? Because they are the answer potentially for youth unemployment, because these guys used to hire up to 3 to 4 million of new grads of engineers and management, new grads, right, every year. So now the government wants to help the internet companies, right? And then we saw a lot of noise also coming from geopolitics as well, like you said, like delisting, which we thought from the very beginning that this shouldn't impact, because any company that delists can list anywhere in the world. But also, it's not in anybody's interest for these companies to list, neither in the U.S. interest or in the China interest. But anyway, we're seeing a lot of rapprochement today between the U.S. government and the Chinese government. Very encouraging. We're seeing a lot of high-level officials visit, talk. That's exactly what we wanted. We're seeing CEOs getting involved in the conversation, businesses in the U.S., and we are really optimistic on what could happen, in the future between the U.S. and China.
Anthony Sassine and Jim Warden, thank you guys. Appreciate your time.
Thank you.
And coming up, the closing bell on Wall Street. We are checking in on the latest market moves and the top trending tickers. Stay tuned.
There There you have the closing bell on Wall Street on this Wednesday, October 25th. Let's do a check of the markets here because we did have stocks really selling off throughout the session here and really landing near the lows of the session when all was said and done. The Nasdaq leading declines off by 2.4%. The S&P 500 off 1.4%. The Dow off just a third of 1%. Or about 105 points here. And let's just dig, Josh, a little bit deeper into what we saw today, particularly from large cap tech here. I want to take a look inside the Wi-Fi Interactive to get a little bit of a more of a flavor for what we've been seeing, because now upon today's close, we had the high for the Nasdaq back on July 19th, and since then we now have had a 10%, can I write it on here, a 10% decline, which means a correction for the Nasdaq Composite. So that's not something that investors necessarily like to see with this downward momentum that we've been experiencing. The Nasdaq 100 today, Josh, it feels like really encompassed the selling, not just the concern around rates, right, which are a concern, but also some real concern around earnings.
Yeah, I mean, you can look at the tape right there. I mean, Microsoft, a nice pop, and then you saw Alphabet just get absolutely wrecked in today's trade. What's interesting, of course, we know that was on the cloud business. It underperformed. There was good news in that report, which is the advertising business, which at the end of the day, this company places a lot of different bets, but that is still their bread and butter. Search and YouTube revenue both came in better than expected and showed acceleration. You wonder, is that a tell on what we expect to hear from Meta here right after the bell? Meta, we should note, it is up, Julie, about 150% this year heading into the print. So you wonder, that is obviously a big move. How much good news is priced in at these levels? Is valuation still attractive after you see a move like that? Other things I'm very interested in hearing from Meta, beyond advertising, of course, Reels monetization, Threads. It's an election year, obviously, coming up. What does that mean for ad spending? Yeah. And the big one, too, is Mark Zuckerberg, who has talked so much about the year of efficiency. And some of the street are wondering, could this become the years of efficiency? And if so, how would investors react to that? The team at Evercore says they expect Meta to maintain or modestly trim 2023 total expense guidance and maintain their 2023 CapEx guide.
And just taking another look at the stock here. So you mentioned the year-to-date performance that it's had, but look at that two-year performance, right? The deep declines that it saw in 2021 on concerns about all the spending the company was doing at that point on the metaverse, right? And then that sort of course correction that we saw on the part of the company, but it's just back to the even line, right? So now the question is, what happens next? And here's a 5-year chart to give a little bit more perspective on that. So I think there are a lot of questions for Meta's direction from here. And I'm also looking at a lot of these other stocks, though. I mean, NVIDIA down 4.1% on the day. That's quite a 5-year chart. But if you look at the day, down more than 4% on the day. Amazon, which is reporting after the close tomorrow, down almost 6% on the day. So it seems like there was really an infection, if you will, from Alphabet to the rest of the tech space. And a lot of that, I got to take it back on the Wi-Fi Interactive. A lot of it comes back to yields, right? So I'm going to scroll up and just take a look at what we saw in the 10-year note today, pushing up again. There's the 6-month chart for the 10-year. I mean, that incredible gain that we have seen in yields, 11 basis points again today. That's just really overwhelming at least some of the sentiment surrounding earnings.
Yeah, and we should mention, of course, we're waiting for Meta, a great read on the ad market. We're also waiting for IBM, Big Blue, which is going to give you a really good read on that broad enterprise IT spending backdrop. That stock, let's do the exact opposite of Meta there. I mean, you can see year to date, that stock has done a whole bunch of nothing. It's actually down around 2 or 3%, but it is a read on enterprise spend. I think we're going to have big questions about their move in hybrid cloud. We'll have questions about AI. How much of an opportunity is that for IBM? Is it a beneficiary? Where do we see that show up in their results? Also, the consulting business. I think investors often aren't big fans of that for a software company because they get worried about its impact on margins. So all big questions for Big Blue as well.
Yeah, and we're going to talk later in the hour as well to the CEO of F5 Networks, which also sits in that enterprise spending stack, if you will, helping with connectivity of companies' apps to networks, also a cybersecurity play. And so we'll be getting a read on and the enterprise spending cycle from that company as well, because there are a lot of questions around it. If companies' borrowing costs are going up,
yep.
That's something that's happening on the expense line. There are still a lot of questions about what's happening on the demand side of the equation, which has seemed to hold up okay, but we'll see how long that lasts.
Yeah, F5 is going to be a great interview because in the near term, I'm interested in what the CEO has to tell us about the spends he's seeing when he's talking to his customers. How confident do they sound about IT spend? The near-term outlook he gave was a bit more cautious than what some of the street were looking for. But beyond 2024, what does he see? Does he see more reasons for optimism and green shoots ahead?
Yeah, so we're still waiting for the Meta numbers, by the way. They were due to hit right around 405, so we're not seeing them quite yet here, but we are awaiting them. Just to give a quick headline of what the estimates are, the revenue estimate, it looks like at about $33.5 billion specifically. The advertising revenue estimate, and advertising revenue is most of their revenue, at $32.94 billion. So we'll be looking for any number or color around that. We'll be looking for number or color around the users, right? Facebook daily active users estimated at 2.07 billion. But you'll hear Meta, as it has been, talking about the so-called family of apps, right? WhatsApp, Instagram, getting any color on what's happening with Reels and what the ad demand for Reels looks like. All of that is going to be interesting when we get the numbers, when they start to drop. All right, let's bring in, waiting for those numbers, let's bring in Daniel Flack, Senior Research Analyst at Neuberger Berman, who we turn to frequently for a perspective on big tech. Dan, thanks again for being with us. So as we await Meta here, what to you is going to be the most important element?
Good to see you. We're going to be watching for how they transition the business. They're continuing to see good traction with Reels in short form video. Business messaging has been an area of growth. And so we'll look to see how that's performing. And we'll also look for insight in terms of their investments. I think they're going to spend more aggressively over the next year in areas like artificial intelligence. And so I think that's an important thing for them to do as they continue to evolve the user experience and drive value to for advertisers.
And hey, Dan, heading into this print, investors, they have piled in, right? This stock has roared. We're going into the print here. It's up about 150%, Dan. Do you think a lot of good news is priced in at this point? And after a move like that, I'm curious to hear your take on whether valuation is still attractive.
The stock has done well this year after, of course, having a difficult year last year. And so the key for the stock from here, in my view, is their ability to drive durable growth and translate that into earnings per share and free cash flow generation. If they can do that, I think the stock can continue to work its way higher over the next year. The key, though, ultimately is really about the innovation and their execution on their product cycles and really evolving the platform. This evolution of the platform to newer areas, weaving artificial intelligence into the experience, that's critical for growth as we think about the next 1 to 2 years.
And just quickly as well, I'm curious, Dan, your thoughts on a theme that we were talking about earlier, and this speaks to the innovation as well, how all of these various companies are integrating AI, and not just integrating, but actually making money from it. That seems to be one of the dividing lines between the Microsoft and the Alphabet earnings. How do you think we're going to hear from Meta on that front?
For Meta, I think there are two elements to it. The first is using the technology to help advertisers derive more insight and ultimately drive the return for those advertisers from their investments in the Facebook, Instagram, WhatsApp, and the broader platforms. The second piece is, of course, the user experience. Competition for user time remains fierce. And so Meta needs to continue to enhance the experience, provide better content suggestions, continue to refine that, engage users in new ways. And if you put those two pieces together and weave more artificial intelligence into it, I think there's potential for that to all help drive better growth as we think about the year ahead.
Dan Flex, please stick around if you don't mind, because we still don't have Meta, but we do have IBM. So I want to bring people those numbers right now. IBM's third quarter revenue rising by 4.6% to $14.8 billion. That's a 3.5% gain in constant currency. And that $14.75 billion, to be exact, is above the $4.68 billion that analysts had been predicting here. You can see adjusted earnings per share beating estimates as well. The company not changing its full year revenue forecast. It says at constant currency, it still expects revenue to rise 3 to 5% this year. That still leaves it some room to beat analyst estimates. So that also appears to be something that is positive for the stock. And we're seeing, as you can see, the stock rise in extended trading here. Gross profit margin for the company on a GAAP basis is 54.4%. On an operating basis, 55.5%. Both of those are gains of more than 1.5 percentage points each, Josh. So that's kind of the first blush here that I'm seeing from IBM. Kind of steady as she goes, but, you know, not doing bad.
Yeah, popping about 2% here after hours. That's the initial take. I'm just reading through the release as well. Looks like the CEO, Arvind Krishna, talking about AI, talking about hybrid cloud. Of course, big focus for that company. Says that's helping drive solid growth in our software and consulting businesses. As a result, he says, we remain confident in our revenue and free cash flow expectations for the full year. I'm just looking through the various segments as well. Looks like software revenues, $6.3 billion. That was up about 8%. Consulting revenues, they say, that was up about 6%, and infrastructure revenues that was actually down about 2%. But again, investors look at this one because it's a read on enterprise spend, and it'll be very interesting. You know, how do they leverage AI, and do investors buy that AI is a real opportunity for this company in the quarters and years ahead?
Yeah, consulting appears to be the one line that missed estimates, although it did see a gain of 5.6%. It was slightly below what analysts have been anticipating. And this is just a monster business. Software is its biggest business, but consulting is the next largest. And so that was going to be an area of scrutiny. And speaks to really the theme that you are talking about here, which is what is the appetite of enterprises to spend right now? You know, consulting is one of the main areas for that.
And 23 expectations, it looks like. Company continues to expect constant currency revenue growth of 3 to 5%, right? And then free cash flow, they say the company continues to expect about $10.5 billion in free cash flow. That's up more than $1 billion year to year, they say.
All right, we are going to take a pause, because guess what? Meta's still not out here. So we've got IBM to consider. We're going to keep looking through some other numbers as well. And when we do get Meta, we'll bring it to you. We'll bring you instant reaction. And we're also going to be talking in a bit to the head of F5. We'll talk to the company's CEO coming up. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Yes.
And we have Meta earnings now. The share's down about 0.75%. Company's third quarter earnings per share looks like coming out ahead of estimates, as is ad revenue. Ad revenue coming in at $33.64 billion. That's above the $32.94 billion that analysts had been predicting here. And the company's fourth quarter outlook, too, is above estimates, or at least the upper end of it is. Fourth quarter revenue coming from the company saying it's going to be $36.5 billion to $40 billion. Analysts had been predicting, call it $39 billion. So there's at least room for it to beat estimates, although the midpoint of the guide is still below perhaps what analysts had been predicting here. Just looking at some of the other headlines here, expenses, obviously a big issue for the company, and it says total expenses for the full year, it looks like, are going to be $87 billion to $89 billion. That is a little bit lower than the company had seen, so it's cutting its expense spending for this year. It was $88 to $91 billion. Now it's $87 to $89 billion. For next year, 2024, it's already giving an expense forecast as well. It says it will be having $94 to $99 billion in expenses next year for 2024. Analysts had been looking for $96.5 billion. I know this is a lot of numbers to throw at you at once here. I think the overall takeaway, and you can see this reflected in the 4.5% increase in the stock as well, that this seems to be a positive quarter. At least the first blush read here is that it's a positive quarter for the company. It does say that next year, Reality Labs operating losses will rise meaningfully. That's not necessarily what the investment community wants to hear, but it's not necessarily a shock either.
No, and so bottom line here looks like beats on the bottom and the top. I'm just looking through some other metrics as well. It looks like Q3 Facebook daily active users, 2.09 billion. That edges out what the street was looking for. Analysts were thinking it was going to be more like 2.07 billion. So beat there. I do see Reality Labs operating losses, 3.74 billion, though that's less actually than what the street thought. The street thought they were going to come in around 3.94 billion, but you can see the reaction, at least initially here, we're popping 4, and remember, we came hot into this print. You were up about 150% into the result.
Hot into the print, but not hot today, right?
No.
Meta shares did fall some 4% today as we saw those Alphabet shares tumble. So that's just something to put in context as well when you look at this after hours reaction here in Meta. Let's get a little more analysis here on these numbers. Bring back in Daniel Flack, Senior Research Analyst at Neuberger Berman. Thanks for being patient with us and being patient with Meta while we were waiting for these numbers to come out, Dan. So what do you make of this? It does seem like, they're still spending a lot of money. I guess it's a little tiny bit less money than they had been planning to spend, but they're still spending a lot.
I think the results look solid overall. They're clearly remain important to users, given how the metrics are holding up. I think the investments both in the core business and Reality Labs will continue to be an area of focus over the next several months. But ultimately, I believe what will matter most is the revenue growth and their ability to demonstrate a growing relevancy with users and with advertisers. And longer term, we'll have to see how the Reality Labs investments pay off.
And Dan, let me ask you, because obviously Zuckerberg has talked about the year of efficiency, and I know some analysts on the street were thinking, you know what if he extends that? What if he starts talking about, years of efficiency, and how would shareholders, investors think about that, react to that? What's your thoughts on that? Do you think this becomes more extended in terms of a narrative that Zuckerberg wants to tell?
I think what they're going to try to do is prioritize the investments a little more effectively in their core business. Reality Labs, I would view separately, given the scale of what they're trying to do, and that's going to take them many, many years and perhaps also result in a different business model. But in the core business, I think there's probably still room for efficiency. The key, though, from where the company is currently positioned is whether they're going to be able to continue to successfully transition into newer areas like Reels, grow their business messaging platform or revenue stream as another example. And they will need to invest to do that. The investments that have expanded this year, and I would expect to see more of the same next year, are, of course, around areas or initiatives like artificial intelligence. That's going to require a continued significant multi-year level of investment, but I think that's the right strategy to help drive relevancy and ultimately growth for the company.
What does that look like? Do you think the company has painted, do you think Mark Zuckerberg has painted a clear enough picture of the why behind that and the what it's going to look like?
I think they're continuing to refine the strategy and the messaging along with it. If the revenue growth in the core business, excluding Reality Labs, remains healthy and they can manage expenses and drive good earnings growth next year, I think the market will be okay with the initiatives in some of the longer term areas like Reality Labs. The key, I think, from one quarter to the next, and importantly as we think about the next 12 to 24 months, is just their ability to innovate, evolve the user experience, engage users, and of course on the other side, continue to drive value for the advertisers, and what, of course, is a challenging economic environment that all companies are facing.
And Dan, I want to talk about AI for a second, too. Meta has introduced several AI-powered product enhancements for consumers, for advertisers. They're clearly being very focused on this. Can we try to quantify the impact that's actually having on the business?
I think what we're seeing is they're finding users are getting better recommendations on content, so they're engaging more. So, for example, if we look at Reels, they're seeing, or they have been seeing, good traction there. And so the technology and the investments in software and silicon behind that are helping to power that transition in Reels is one example. Business messaging and having AI agents help small and medium businesses engage with customers and potential customers is another area where I think we're seeing the technology investments in the innovation help drive tangible results.
Dan, there is a mention of the regulatory environment in this statement. The company says it continues to monitor the active regulatory landscape, including increasing legal and regulatory headwinds in the EU and the US, that could significantly impact our business and our financial results. And they also note the FTC, according to this release, seeking to substantially modify our existing consent order and impose additional restrictions on our ability to operate. They say they're contesting that, but I am curious about your view on not just what's going on with the FTC, what's going on with the attorneys general around the U.S. Is that going to affect the company's growth at some stage?
I think what the company needs to do, and really the broader industry, they need to do a better job explaining the business model, how data gets used, what they're doing to safeguard privacy and user data. I think they have to increase the transparency around all of this, and I think they need to engage even more with regulators. It does, or the regulatory actions do have the ability to hamper their operations or could potentially impact their growth. I think it will certainly result in them needing to continue to invest aggressively to make sure that they're both safeguarding data and also building new tools, which they've been doing to help advertisers get value from the platform, even in a world where there's less data from some of their users, and there's a greater focus on privacy. And so we're continuing to monitor it very, very carefully. I think what will matter most as we think about the next 12 to 24 months is whether the company can innovate and grow, even in the face of what will be an increasingly challenging regulatory environment.
Bottom line here, when you look at these results today, combined with the outperformance we've seen over the past year or so, do you want to buy the stock looking at these numbers at first blush?
We currently own the stock. We've owned it for some time. We like what they've been doing over the last year. When we look at investments across the broader space, what I think stands out after some of the what we saw today and coupled with the results last night is Google, where we continue to think search is durable. We saw acceleration there. We saw acceleration in YouTube as well. And so I prefer Google here at current levels, but we continue to own Meta. We continue to think it's well positioned. And I think there's room for that stock to also outperform as we think about the year ahead.
Daniel Flax from Neuberger Berman. Thank you for joining us, Dan. It's always great to get your insight.
Thank you.
Turning on a multi-cloud application services and security company, F5 out with a beat on estimates in its latest quarter. F5 seeing double-digit earnings growth in 2023. However, more cautious customer spending tempering 2024 revenue growth. Here to discuss is F5 CEO and President Francois Locoh-Donou. So, Francois, thank you so much for joining us.
Thank you for having me.
I want to start, Francois, just with that September, the quarter results and the outlook. For 2024, Francois, you expect revenues to be flat to down low single digits versus street expectations of plus 1% growth. I'm just interested, Francois, what you're seeing there and why you were a bit more cautious, at least relative to street expectations about the near term.
Thank you, Josh. Well, we had a solid Q4 with a strong beat on the top and the bottom line, and that's driven by what our customers are doing around their applications, how they're securing and protecting their applications. When we look at 2024, Josh, what we're seeing generally in the macro environment is enterprise customers are still cautious. They're still reluctant to engage in large transformational projects, and budget scrutiny is still quite intense with the vast majority of our customers. On the other hand, customers are actually consuming existing agreements. We are seeing very strong renewals and expansion of those agreements, and that is largely driven by the growth in applications, the growth in APIs that need to be secured. And we think that as digital transformations continue to progress, we're going to see more and more of the growth in apps and APIs that our company is focused on securing and protecting.
And Francois, though, in the near to intermediate term, listen, the macro, it is what it is. If it's more uncertain, how do you navigate that, though, as the CEO? Are there levers you're pulling? Are you making changes to, where you're focused or your investment or your spending?
Well, we are laser focused, Josh, on the opportunity we see in multi-cloud. And what you're seeing in large enterprises is multi-cloud has gone mainstream, meaning most enterprises have now their applications running in multiple public clouds, on-prem, at the edge. And the task of securing and delivering and optimizing these applications across these infrastructure environments is actually dauntingly complex. And F5 is laser focused on the mission of making it way easier for enterprise customers to secure and deliver their apps against these in these multi-cloud environments. And so the way we're balancing with the macro environment is, of course, we're being disciplined about how we spend our dollars, but really doubling down on our investments to pursue this multi-cloud opportunity for which we think we're quite differentiated.
And of course, as are most companies right now, you're talking about AI as well, Francois, as a way to differentiate, as a way to push customer demand. Talk to us about, I guess in as much layman's terms as you're able, talk to us about that integration and what it means for F5.
The AI opportunity so far and the AI story has really largely been about the chip providers like NVIDIA and the hyperscalers, the big public clouds, where a lot of these large language models are being trained, and we see that opportunity playing out in companies like Microsoft, for example, even yesterday. Where we think the next opportunity will be in AI is in the adoption of AI by enterprises. And we think that large enterprises will run their AI workloads everywhere. We're hearing from customers they will want to run these AI workloads in data centers, in public clouds, but also, for manufacturing companies on the manufacturing floor close to the machines. For retailers, they'll want to run them in branches. And so we think that these AI workloads will be highly distributed in where they run over time. And this is where F5 has a very interesting opportunity, is that we're uniquely positioned to be able to secure and deliver these workloads, not just in public clouds, not just in data centers, but in any environment where any enterprise would want to run AI workloads.
And Francois, I want to get you out of here on this, which is just get your take on that cybersecurity landscape. You have unique insight there, Francois. What are you seeing there? Because I've heard you describe it as a ransomware epidemic right now. So I'm interested, what is driving that epidemic, and how is F5 positioned to help customers meet and deal with that challenge?
Well, what's driving that epidemic is the availability of tools for attackers to attack companies. And so even attackers that are not sophisticated can now mount pretty simple attacks pretty quickly. And the availability of generative AI gives new tools to attackers to drive that even further. So I expect an acceleration in that epidemic. And I think enterprises are going to have to tool up to be able to protect against that. F5 is actually has invested in AI to protect against automated attacks. We've invested heavily, specifically in machine learning and AI, to be able to detect automated attacks and protect from not just financial services crime or account takeovers in financial services, but also manipulation of social media and distortion of the digital world as we see it. And we think that really is, in the next decade, where the fight is going to be, is, AI used by the good guys, if you will, against AI used by the bad guys.
All right, Francois Locodonu, thank you so much for joining us today, Francois. Appreciate it.
Thank you.
And coming up, we go around the horn with some of today's top stories, including price hikes at Apple TV Plus. Stay tuned.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal here with Josh Schaefer and Praz Supermanian, and we're talking streaming and we're talking price hikes because today we got the news that Apple is hiking the prices of some of their subscription services, including Apple TV Plus. Apple TV Plus was $6.99, now it's going to be $9.99, so rising by $3 there. If you remember when Apple TV Plus first debuted in November of 2019, it was $4.99. So we're seeing not just at Apple, but really streaming platforms, tech giants, media companies across the board raise the prices of these streaming services. Now, this is coming as Wall Street doesn't really care about subscribers anymore. They're really focused on profits and on revenue. But virtually every single streaming platform has raised prices this year, some even twice. Disney raised them twice in 1 year. And it makes you think how much longer this could go on, and at what point do consumers just give it up and start to unsubscribe?
For me, zooming in on Apple for a second, because they had the price hikes today and we're now looking at $10.99 for Apple Plus, you wonder if this is going to change their content strategy at all. We know Apple has been very focused on quality over quantity, the same way they are with most of their products, right? They presented a very high quality video product with highly produced shows, like say a Severance, and there's only a few episodes, but you kind of love it. Ted Lasso, very popular. If I'm paying $10 a month, you better give me some more shows. I've been waiting for season 2 of Severance to come out for over a year now, and I know the writer's strike had something to do with that, but that's a real issue that's just happening right now. They had the writer's strike happen. They haven't had as much content. None of these streamers had much content. If you're gonna hike prices, I better be getting new content for me to stay with that streaming service month over month. Right now, I don't know if the Apple library has that.
Yeah, I think it was mostly about, we got these entry-level cheapo prices to get people in the door, get that land grab, get people in, maybe on board with $4.99 for Apple TV Plus, and then we had Netflix on lower prices before, and as well as Disney also came out the gate with a very low price, if I remember correctly. But then we all got on board, and then they said, slowly creeping up. Like you said, Wall Street wants to see some performance as opposed to like those growing subs. You want to see them make money. Kind of reminds me of Uber back in the day when they would just sort of, subsidize everything there for you to get on their system and then get you later. So.
You bring up a good point, though, Praz, because Disney CEO Bob Iger has said, I think we were priced too low. And maybe we are finally paying the adequate amount for the value of streaming. A lot of these executives had said, we are providing a tremendous value to you as the consumer, that you can sit on your couch, not have to leave, not have to do anything, and access all of our content. Their argument is that they probably were priced a little too low when they first came to market because they did want to get as many subscribers as possible. Now that that's not so much the focus anymore, now that a lot of these companies are maturing a little bit, now they need to show that they have the margins, that they have the money, that they're an actual business and not just this growth idea and growth product.
And the biggest problem that comes with that, though, is now people are doing math in their heads, and it's getting expensive. It might remind us of some cable bills we used to pay to have all these streamers if you want to have all of them. Allie, you're the streaming expert. It's your beat. It's your favorite. I want to throw to you first. We've been debating what the go-to streaming combo is now.
Yeah.
What would you have if you could sort of recreate your basket right now and get a set of streamers?
It's pretty tough because we had this debate on whether or not we should include cable replacements like YouTube TV, because that would certainly be in my basket. But we avoided the cable replacements and we're just focused on the streaming platforms. I would go Netflix, the ad plan, because I'm not paying more than $6.99 for trashy reality TV that I go to Netflix for. I would also have the ad plan for Max. But that's contingent on the types of shows that Max debuts.
You mean you'd pay for the
I'd pay for the ad-supported option in order to save a couple extra bucks.
In both services?
Yes, in both services. But with Max, I think I would only want it when I had the new season of Sex and the City and Just Like That, and a new season of The White Lotus. Other than that, I don't really need Max.
Yeah.
And then, of course, with Amazon Prime, you get that with the Prime shopping. That's an added value that
so I have the same three you had, plus ESPN Plus. I'm a big sports fan. I do think there's great value in the amount of games, specifically NHL games, Boston Bruins outside of market I get here. I love it. But I think really when you look at what you're getting from the other ones, it's Netflix and Max are sort of the ones you can flip on any night and just watch like casual TV more or less. And then Amazon Prime to me is still bringing you something because you get something else with the streamer. Are these streamers going to be able to do that? I'm not going to unsubscribe from Amazon Prime. I want Prime. Praz, what you got?
All right, you Gen Zers are crazy wanting to pay less
I'm a
money.
millennial,
wanting to
Pras.
pay less money for ads. No way, I can't do that. I will not pay for ads. I will not see ads. I'll pay not to see them.
Mhm.
So I'll go with the Netflix premium content, $22.99. That hurts.
Well, that's
there
me.
they are. There's that. And then we had Josh's earlier.
All right, I was
Yeah, but
31. I'm just under $32. That's not tragic.
I was
Ooh,
over 40.
bougie Pras.
Pras is at the highest. Because he went no ad tiers though. If you
Yeah,
go
he went no
premium,
ads.
if you go premium Netflix at $23, I mean it is expensive. Right?
And if you add that $74 something YouTube TV cable replacement that I would, then that brings you up to almost.
we just got to get Pras on TikTok more, like us Gen Zers. You don't need all these streamers, Pras. You can just scroll your phone.
I do
It's
watch a lot of
perfect.
regular YouTube. So.
Okay, all right.
Anyway.
Well, we're going to continue to analyze our bills and what we're actually paying for with these streaming services, but we have more Yahoo Finance coming up on the other side of this break. Stay tuned.
Shares of Mattel are trading lower by 6.6%. That's despite the company reporting better than expected third quarter results. The company did come out with an outlook that disappointed some investors. Joining us now for some perspective, Citi Leisure and Travel analyst James Hardiman. He also happened to initiate coverage on Mattel last week with a buy rating. James, it's good to see you. It's always good to see you. So there were a lot of high hopes for Barbie here, right? Not just for last quarter, but more going forward into the holiday season. What do you think is going on here at Mattel? What's your first blush reaction?
Yeah, I mean, the first blush reaction is that this is not a Barbie issue at all. What's become clear is that I think a lot of investors are trying to look at their business sort of ex-Barbie, I should say, so that we can try to figure out what earnings power looks like for 2024. And so it was a really good third quarter. They beat by about 33 cents, but they only raised by a nickel. And so I think the interpretation here is that the fourth quarter is guided down, call it 27 cents. I think the implied guidance for the fourth quarter is 26 cents. The street was at 48. And so the interpretation here is that they're guiding down the rest of their business effectively for the fourth quarter. I guess the other way to look at it is they had sized the Barbie effect about a month and a half ago to be about $125 million. That's about a 20-cent benefit. And again, they're only raising 5 cents here. And so I think a lot of people are just thinking about how difficult it's going to be to hit the 2024 number, given that the 23 numbers are barely going up, despite what was a really impressive contribution from Barbie.
And James, on the top line in your note, you point out the missing narrative ingredient here is the reignition of the top line. So do you see reignition happening here, James, on the top line, and what would drive that?
Yeah, I mean, certainly they grew the top line nicely in the third quarter. The implied revenue growth for the fourth quarter is about 15%. So we are beginning to see that pick up. The challenge is the street was at about 25% growth for the fourth quarter. So, we're seeing the reaction in the stock, which is, effectively that growth that they're guiding to implicit in the fourth quarter number is not quite what the street is looking for. And maybe more concerning that it's going to be a challenge once we get to the third quarter of next year and the fourth quarter of next year, for that matter, to lap this pretty meaningful Barbie benefit.
So I'm looking at gross billings in North America in particular, which were up 10% overall. Strength in dolls, including Barbie, not surprising. Strength in Hot Wheels. And weakness in pretty much everything else, from action figures to building sets, infant, toddler, and preschool. That's Thomas and Friends, the well-known brand there. What's going to reignite this stuff? Is it going to be some of the property, some of the other media properties that they're talking about linked to some of these brands? Is it going to be the macro environment? What do you think?
Yeah, I think it's all of the above. I think you nailed it. Dolls are doing really well. Vehicles are doing well. Preschool is down a little. Action figures are down a lot. Now, the latter, I think, is a function of some difficult entertainment comparisons. And so in any given quarter, any given year, you've got a portfolio, and some of your brands, some of the categories are going to be up and some of them are going to be down. I think as you fast forward to next year, interestingly enough, I think preschool and action figures should at least flatten out. The challenge is, what's going to happen in the dolls category. Interestingly enough, vehicles have that category has maybe been the most resilient over the last few years. Did well during the pandemic, but even post-pandemic, we've continued to see growth there. So, a lot of it is sort of what's going to offset what. And I think as we sit here today, I think investors are struggling with just how conservative is this guidance, or does it reflect a real slowdown in top line trends ex Barbie? But the other piece that we don't know is, what's the entertainment opportunity for next year? So many of these toys are really driven off of entertainment offerings, that their demand is a reflection of entertainment. And so until we have a better idea of what the entertainment slate looks like for 24, it's a little difficult to tell.
James, I gotta say, you don't necessarily sound like a guy with the buy rating on the stock, right? At least the tone that you're expressing is much more uncertain. Why buy the stock here?
Yeah, I mean, I think so much of, I think the hedging, the uncertainty is the same thing that I think investors are faced with here, and that is, this is an uncertain holiday season, right? And we felt good to be able to maintain their guidance, hopefully raise, and we saw that. But now we got to button up for a holiday season, which, by all accounts, I mean, consumers are pensive. Consumers are conservative. They're being hit with higher interest rates and higher inflation. And so we're going to have to see. I think longer term is really the excitement that we have for Mattel. And I think what a lot of this analysis misses is I do think the success of Barbie is not just a one-hit wonder. I think there's opportunity for sequels. I think there's opportunity for Mattel to really step up their entertainment game in some of these other brands. Is that going to help the comparisons in 2024? Maybe not. But I think if we think from a long-term perspective, once we get past some of this macro malaise, once we get past some of these difficult comparisons, I think there's a lot of value here.
All right, we'll be looking ahead to the Hot Wheels movie and whatever else is coming down the pike. James Hardiman, great to catch up with you as always. Appreciate it.
Likewise. Thanks, guys.
Coming up, what to watch tomorrow. We'll get you set up for everything you need to know on Thursday. Stay with us. Let's take a look at some of the trending tickers after hours, some of them having to do with what's going on with earnings. One of those is ServiceNow. Now you see the company's shares popping in extended hours trading here, up by some 4.68%. Intraday, though, they did fall by about 4%. The company coming out with its outlook for the current quarter that appears to be better than what analysts had been anticipating. Subscription revenue, it says, is going to be $2.32 billion in the current quarter. That's a little bit higher than what analysts had anticipated. Operating income profit margin, it's predicting at 27.5%, which is in line with estimates. Now, this is one of those big enterprise-facing companies that we have been watching closely, right, to see what kind of read they're giving us. And the CEO, Bill McDermott, always ebullient, has said that the company has already signed several multiple million-dollar deals for a new product that it has released, which includes some capabilities for generative AI, of course, the buzzword of the day. Non-earnings related, Endeavor Group. We are watching that entertainment and talent agency powerhouse saying it's exploring its strategic options here. Those shares are up almost 12% in extended trading today. The company didn't go public that long ago, right? If you look at, let's say, a 2-year chart here, you can see the trajectory. It IPO'd back in 2021, back in April of 2021, at $24 a share, and now is only trading at under 18. So that explains why they want to look for options here. Ari Emanuel, the CEO, saying, "We believe an evaluation of strategic alternatives is a prudent approach to ensure we're maximizing value for our shareholders." At the same time, the company says it's not interested in exploring selling a stake in TKO Group Holdings, which, remember, is the marriage of WWE and UFC. And then finally, Align Technology, the Invisalign company, down 21.5%. And you're looking at the 2-year chart there, which is also an ugly one. It's down 57% in that period of time. The company cutting its net revenue forecast for the full year. Now, the upper end of that forecast is $3.85 billion. The lower end of it was $3.97 billion. So hence the decline that we're seeing here. The company says it expects to lay off workers as well. And so the company says both clear aligner and systems and services revenue will be down sequentially. They're blaming a challenging macroeconomic environment for doctors and patients.
And time now for what to watch on Thursday, another packed day of earnings. In the morning, investors can expect to hear from companies such as Royal Caribbean, UPS, Comcast, and Southwest Airlines. And then after the market close, Amazon, Intel, and Ford among the key names to watch. As for Amazon, investors are going to focus on Amazon's cloud business, AWS, as Microsoft reported better than expected growth in its Azure business. The impact of AI will also be a point to watch when Intel reports as the competition heats up on chips. And as for Ford, a spotlight will be on the company's financial outlook amid the United Auto Workers strike. And meanwhile, on the economic front, we're going to get the latest reading on the U.S. gross domestic product. GDP is expected to increase at an annual rate of 4.7%.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern. Is it Amazon Day tomorrow?
Sure is.
It's Amazon Day tomorrow. So we'll have all those results for you and much, much more. We'll see you then.